So, how do you protect yourself from a market that can literally wipe out a year's worth of profit in an instant? Whether you're growing wheat or trading stocks, this is the fundamental problem of risk. And in this explainer, we're going to break down the two powerful financial tools designed to solve it, starting with a really simple farmer's dilemma.
Yeah, just put yourself in those shoes for a second. This isn't some abstract theoretical problem. It's a real-world nightmare. You spent months, all that hard work tending to your crop, but the final price you get for it is completely out of your hands. That fear that a market swing could erase everything, that's the very reason the financial instruments we're about to talk about were even invented.
So, what if you could just eliminate that uncertainty? What if you could agree on a selling price for your wheat right now, months before you even harvest it? Well, it turns out you absolutely can, and the first solution is probably simpler than you think.
Okay, so the first and most straightforward solution to our farmer's problem is an agreement called a forward contract. You can really just think of it as the financial version of a firm handshake deal. It's a direct promise between two people.
So what is it exactly? Well, a forward contract is a completely private deal. You and a buyer, let's say it's a big bakery, you negotiate the terms directly, just the two of you. This happens over the counter, or OTC, which is just a fancy way of saying it's not done on a public exchange like the stock market. The key words to remember here are private and customized, because every little detail is up for grabs.
Let's break that down a bit. You negotiate absolutely everything: the exact quantity of wheat, the delivery date, and most importantly, the price. Now, by agreeing to sell, the farmer takes what's called a short position. They're short the wheat until they deliver it. The bakery, on the other hand, agrees to buy, so they take the long position. The great thing is, both sides get certainty, and the whole deal is settled just one time, right at the end, when the wheat gets delivered.
Sounds like a perfect, simple solution, right? A custom-fit deal that gives everyone total peace of mind. But that beautiful simplicity hides a massive flaw. What happens when one side gets tempted to break their promise?
And this brings us to a really crucial concept: counterparty credit risk. It's a complicated-sounding name for a very, very simple problem. It's the risk that the other person in your deal just won't follow through, that they'll default on the agreement.
And here's the problem in a nutshell. Let's say wheat prices suddenly double. Our farmer looks at that private contract and realizes they could make way more money just selling on the open market. The temptation to just walk away is huge. And because it's a private deal, the buyer's only option is to drag them into a really costly legal battle. Suddenly, the contract's greatest strength, its privacy, becomes its greatest weakness. This exact problem, this problem of trust, led to a really ingenious evolution in finance. It led to a better mousetrap, one designed specifically to solve this counterparty problem. So let's welcome the futures contract. This right here captures the fundamental shift perfectly. We are moving from that private, custom-made deal to a public, standardized agreement. So instead of a one-on-one negotiation, you're now trading on an open exchange where the terms, like the quantity and the quality of the wheat, are exactly the same for everybody.
So how do you solve the trust issue? Well, the exchange introduces this incredibly powerful middleman. It's called a clearinghouse. Now, the farmer and the baker, they no longer deal with each other directly. Instead, the clearinghouse becomes the buyer to every seller and the seller to every buyer. It guarantees the whole transaction, completely eliminating the risk that the other side will just bail on you.
This table just lays it all out beautifully. We've already talked about the venue, OTC versus a public exchange. We've covered the agreement, private versus standardized, and the risk, huge counterparty risk versus no counterparty risk. But look really closely at that last row, settlement. A forward is settled once, at the very end. A futures contract, it's settled daily. And this is the other massive difference, and it's all about how and when the money actually moves.
For anyone who's interested in quantitative finance, this next part is absolutely essential. I mean, understanding the cash flow mechanics is what truly separates the novice from the professional. This isn't just about the structure of the deal, it's really about the underlying mathematics. So, this daily settlement process has a name. It's called marking to market. What it means is that unlike a forward contract, where you have to wait months to find out if you won or lost money, with a futures contract, your profit or loss is calculated and settled up at the end of every single trading day.
Okay, so here's how it works, in 4 pretty simple steps. First, both you and the other party have to post a small amount of cash up front. It's called an initial margin, kind of like a good faith deposit. Second,
The price of that futures contract, it's going to change all day long. Third, at the end of the day, the exchange marks your account to the final closing price. And fourth, and this is the cool part, the gain or loss is instantly added to or subtracted from your account. You win or lose in real time.
All right, so as you can probably guess, this super sophisticated system isn't just for farmers anymore. The efficiency and security of futures contracts have made them a foundational tool in modern finance. Let's take a look at how they're used on a global scale. And this is where it gets really, really powerful for quants. Instead of painstakingly going out and buying all 500 individual stocks in the S&P 500, a trader can simply buy one single S&P 500 futures contract. And just like that, they get the exact same price exposure to the entire index in one clean, super efficient trade.
Futures also give you access to massive leverage. Remember that initial margin you have to post? Well, it's just a tiny fraction of the contract's total value. So, for example, you might only need to put up, say, $10,000 in margin to control a contract that represents $200,000 worth of the S&P 500. This dramatically amplifies your potential profits. But, and it's so crucial to remember this, it also amplifies your potential losses.
Now, there is a vital distinction we have to make here. An option gives you the right, but not the obligation to buy or sell something. Forwards and futures are totally different. They are binding commitments. They come with the obligation to see the deal through to the end. There is no choice to simply walk away if things go against you.
And this really gets to the core of it all. The leverage, the daily marking to market, the binding obligation, these aren't just details. Mastering these precise mechanics is what elevates a trader from being a gambler just hoping for a lucky break to a professional who truly understands and manages risk. So, as we wrap this up, the final question is really for you. These tools, they're powerful, they're precise, and they're built on a solid foundation of mathematics. Now that you understand the difference, which side of that math do you want to be on?